And my old boss, Barton Biggs, very famous investor and strategist, used to say that the news doesn't have to get better, it just has to get less bad. And I think certainly in the case of emerging markets and markets like Brazil and Mexico and others, that a lot is already in the price. The news is probably not going to just turn around and become fantastic, but it's probably already in the price, as you say, and is going to get less bad in terms of thinking about COVID, less bad in terms of thinking about the economy, less bad in terms of thinking about the beneficial impact of significantly higher commodity prices, particularly bullish for Brazil. And these things suggest that that bad news has kind of led to a split between the Brazilian equity market and its traditional historical relationship with the major commodity prices. And so we have commodity prices now leading the cross-asset world in terms of year-to-date performance, and Latin American equities until very, very recently, trailing quite far behind. And so when I think about things like the economists cover, what that tells me is that the kind of the generalist investor, maybe the global investor, is not really exposed to Latin America or to Brazil. And in fact, I saw Bank of America, one of their recent research publications, showed a table that suggested net flows to Brazilian equities year to date are negative, still negative. And
yeah, so, because they were very bad in the first quarter.
Yeah, and so there's tremendous room for the non-EM specialist investor base, which is obviously huge, much bigger than the specialist investor base. There's tremendous amounts of room for them to allocate to some of the Latin American markets, which climate is going to be a decade-long, at least a decade-long event. And therefore, investors must learn to understand it, understand what's going on, and look for ways to profit from it and participate in all that's going to change in terms of decarbonization, electric vehicles, power generation, etc. So there's a real alpha generating potential, I believe, particularly over time. So if you're a longer term investor, you really should be thinking thematically, and you really should have at least a portion of your allocation or a portion of your portfolio allocated to these themes. Because one of the things that I do in the portfolio review process is go through the technical positions of pretty much every single holding. And it was really illustrative when I did this last week for the June model portfolio update. It was really telling in a sense that of the 28 positions in the model, almost all of them looked very solid technically. So notwithstanding all the news you hear about, bubble and overdone and expensive and all this kind of stuff that I guess sells newspapers or captures eyeballs, I think it's just completely misplaced. And so when I went through all the positions, as well as a half dozen or dozen of on our watch list, almost all of the positions technically looked very solid. So that tells me that we don't have to fear a major correction in the equity market. And the other thing that it told me as I continued to look at across asset technical levels is that a lot of assets are on kind of important levels. If you look at parts of the technology space, Apple is flirting with its 200-day, I think just broke it last week. If you look at Bitcoin and GBTC just broke its 200-day average Friday and again today. The bond market is on important technicals, and the dollar is on important technicals. So technical analysis in a market like this, where fundamentals are hard to kind of get a handle on because you are looking at unprecedented volatility, technical analysis is something that I think really can help. And so I'm of the view that technically the market is quite sound. I don't agree that the market is overly expensive. I don't agree that we're in a bubble. I think we're actually in a pretty well underpinned global equity market expansion that's in its early phase. And I'll just give you a couple of data points on Japan. Japan is a market nobody talks about, because now, I've been bullish on Europe, as you know, for quite some time. And now I'm quite bullish on Japan, but very few people are talking about Japan. People are talking about Europe, and fund flows are starting to move in that direction. But Japan's economic surprise index just hit a record. Their leading economic indicator just hit a 7-year high. The COVID vaccination process looks a lot like Europe. In other words, very slow to get off the mark, but picking up speed very rapidly. You're going to have the Olympics, which has been nothing but a negative headline. Most likely going to happen on time, and going to be successful, in my view. You have a very cheap currency, almost 110 yen to the dollar. All these things, and you have a cyclical equity market. And all these things are happening at the same time, and yet nobody owns it, nobody talks about it. That the dollar's on a pretty important technical support level, and it's been flirting with it, for months. But in terms of thinking about DXY here in particular, should the dollar break that technical level, then it has, fairly significant downside room to fall. And I'm not talking about, a massive sell-off of the dollar. I'm just talking about a dollar that's going to go down maybe 3-5% or so over the next couple of quarters, which will provide another support for commodities, provide another support for EM, provide another support certainly for EM local currency debt, which we're positioned for. And I think it's going to happen in large part because we're going to move from this environment where the U.S. is the strongest grower, the U.S. is the most successful with its vaccination, to this global synchronized recovery, which is going to reflect, a Europe, as I just mentioned, growing stronger than the U.S., a Japan that has, is really starting to move, and parts of emerging markets like Latin America finally coming out of this kind of long period of disappointment with COVID and economic weakness. And so to me, that kind of synchronized global recovery spells weakness for the dollar. And I expect the foreign exchange market to join the rest of the major asset classes with some volatility, and it's going to be centered around a weaker dollar. Yeah, I think it's just at the very beginning. Some of the real smart folks I talk to and I listen to, again, that's one of the benefits of having been in the business for, several decades, is that you do have your group of people that you can talk to, or folks that you read and to pay attention to them at certain points in time because you've studied their work for years and years. And I think that's a real advantage for me, again, in this world where there's so much information coming at you from all angles, to have a couple trusted sources, kind of like I mentioned earlier with the thematic stuff and Kathy Wood at ARC, to have some trusted people that you can read or talk to, I think is very, very valuable. And I offer that obviously myself with TPW advisory to people, but I also myself have my own group of people that I pay close attention to. And I think, we're just beginning the move in, the economist cover. We go back to what we started with, the economist cover suggests that the general populace, the broad universe of people, are not yet on board with the idea that there's an opportunity in Latin American equity, or there's an opportunity in Japanese equity. People are starting to get on board with the idea that there's an opportunity in European equity. But we want to be early in that process. So when that flow comes, it can help drive us higher, right? That's where we want to be. We want to be a little bit early, where we think the risk reward is very compelling. And so that's where I think Latin America is right now. The risk reward is very compelling. The currency is got further to go. The stock market has further to go. Earnings, the economic recovery, all that has much further to go. And I'd say the same elsewhere in Japan and in Europe. So to me, it's still early days in terms of the generalist universe. But I think there's more and more interest in emerging markets. I don't think people have quite yet moved from interest in EM to interest in LATAM, right? And as we talked about earlier, just straight EEM, the broad equity ETF for emerging markets is 70% or 80% Asian. So that's the point that is not yet fully understood.